All right, this is one of the craziest days I've ever seen on the market in my entire investing career. And I mean, we're looking at some of the largest intraday swings in the Nasdaq in history. I mean, this would have to be top 5 at least. I mean, we started out the day, if we look here, we're down around 5.09%, and then we went up to green by 4.23%. So we're looking at around a 9.3% swing. And if we look at the times here, we're looking at 9:42 Eastern and 10:18 Eastern. So we're talking about a 9% swing. Trillions, like the amount of money is just hard to fathom in that short amount of time. And it was all based on a rumor that there was going to be a 90-day pause. So Kevin Hassett, which is a Trump economic advisor, there was an article that came out that said that he had stated that Trump was considering a 90-day pause on tariffs everywhere except China. The only difficulty is he actually didn't say this. The markets absolutely skyrocketed. And in, a little over an hour, they came out and said, the White House denies that Trump is considering a 90-day pause. And what do we get here? We get a big, massive fall down. So this is going to be, and I said this in a video I posted last week, the most volatile time in the markets that we've probably experienced since the financial crisis. Like I would pretty much go out, I would say that's almost a guarantee. This is going to be more volatile than the COVID-19 pandemic, which seems absolutely insane to say, as I mentioned, because we had a global lockdown. But this is the reality of the situation and why it makes it so dangerous trying to time things like this. I mean, we're looking at 1.48 on the Nasdaq. I'll refresh it. I bet you we're half a percentage. We're a full percentage. We're almost a full percentage in just the, minute and a half it took me to film this section. So there's a lot of investors that are, especially newer investors, that again are obsessed with trying to find the bottom here, trying to find opportune entry times, exit times, things like that. And I do believe that, it is during situations like this where you will make the biggest mistakes of your investing career, whether it be you're trying to allocate a ton of capital here to try and time the dip, whether you're trying to take advantage of this, intraday action where, you wake up, you're trying to find the bottom here, you notice, there's a rumored 90-day pause, so you pull the trigger once it's up a bunch, and now we're sitting at, losses again over the course of the first few hours of market opening, which is just, it's absurd. And then we start to make brutal mistakes when it comes to our money. I mean, the best strategy, and this is one proven by, a lot of historical data, is to make routine purchases at regular intervals. We're not trying to time the dip. We're not trying to do anything else like this. We're just sticking to our plan, which seems very easy to do during a bull market. I mean, I've seen tons of investors who, every paycheck, they buy stocks. They buy stocks with a certain part of their paycheck and they carry on with life. However, when this bear market hits, people always want to do more. They always want to try to kind of add more money during drawdowns, things like that. But this has been a strategy that simply has not worked. They've compared this to a dollar cost averaging strategy, just simply buying routine purchases every couple weeks, every month, every couple months, whatever the situation might be. It has outperformed a buy the dip strategy. Somebody who's trying to time these dips, time these market dips, take advantage of lower prices. And I'll get to lower prices in just a second because that might not be all it's cracked out to be either. But 70% of the time, you take somebody who is simply making routine purchases and somebody who buys the dips. And this is assuming that they actually nail the bottom of every single dip as well. 70% of the time, the person who just bought at regular intervals will outperform the person who attempts to time the dips. There is a study on this. I'm not going to go over the study in depth in the video. Instead, I will drop a link in the description where you can read the study if you don't believe me. This is actual historical information, back-tested data that suggests this. And where it gets even worse is they factor in the idea that somebody who's timing the dips is very likely to not time the bottom absolutely perfectly every time. And if this is the case, they kind of alter the data to say that, people miss the bottom by a certain amount on either end. Either they catch it before it bottoms or they catch it a little as it's recovering. And in that situation, simply having a clear strategy, buying at regular intervals, outperforms somebody who's trying to time the dip 90% of the time. 9 out of 10 times. Somebody who simply stuck to their strategy, what they were doing during a bull market, they stuck to that. What they're doing during a bear market, it's the exact same thing. They will outperform somebody who is trying to modify their strategy to try and take advantage of lower prices during times like this. So I'll leave a link in the description to that. But on the element of stock prices are cheaper. Now, it's pretty easy. I mean, we come here, we're looking at year to date, nearly 20% on the Nasdaq, 14.4% on the S&P 500. It's fairly easy to come to the conclusion that stocks are cheaper. However, the market values stocks on a forward earnings and forward free cash flow basis. What is extremely hard to predict right now? The forward earnings and forward free cash flows of these businesses. Why? Because there is widespread tariffs going on across the globe that, again, are changing on a whim. We got this rumor this morning that they were going to be paused, but it looked to be completely fabricated. It seems a little suspicious why they caused a 9% jump in the market just to shut it down within half an hour. But anyway, that's a conversation for an entirely different video. But it is so hard for anybody to predict the overall impact of this, the overall forward earnings projections of these companies. So we have no clue how expensive or how cheap stocks are. If we think of year-to-date gains, negative 19%, negative 14% on the S&P 500, if we hit a global recession and, U.S. earnings, corporate earnings fall by 15, 20%, stocks aren't any cheaper today than they were before all of this. I mean, the market is pricing in effectively a global recession because they do believe that this is the very likely result of these tariffs. Now, could things be reversed in a matter of minutes? Yes, Trump could come out, say he negotiated a bunch of deals with countries, and this could all be over. However, this could not be over as well. These tariffs could persist. They could linger. I mean, Trump has a pretty large motivation to somehow get Fed policy rates down. He wants to get long-term bond rates down. This is likely in an effect to kind of mitigate the overall debt situation in the United States, but he's consistently pressuring the Fed to lower rates, which, I mean, the Federal Reserve and the Bank of Canada, they're supposed to be completely independent, and they're supposed to effectively manage inflation, manage money supply without political interference. And he's constantly jabbing at them to lower interest rates. So, I mean, there is some sort of motive here beyond just the trade agreements. That's something I mentioned back in my previous video, which I'll link to above. And because it is so hard to predict future earnings because of these, essentially a attempt to completely reform global trade, we have no idea where forward earnings will be. And as such, we really have no idea how expensive or how cheap stocks are. Now, on an indexing level, this does become a little bit easier because you're buying a broad scope of companies. I mean, if we think of the S&P 500, you're talking about the 500 largest companies in the United States. And if a global recession were to hit, yes, it would be impacted, but ultimately your range is wide enough there. It's probably not going to be that large of a deal. However, if you're investing in individual equities, the risk becomes much more amplified because you really have to be looking into these individual companies, how they're going to be impacted, what the forward earnings projections are, because there is companies that if these tariffs stay in place for very long, they will be materially impacted. This isn't just a situation, a close your eyes and buy the dip situation. This is definitely something you need to keep your eye on. And assuming that all stocks are cheap just because they've fallen, that's not necessarily the truth. I mean, we can think of a company like Apple who is expected to be materially impacted by the tariff situation. It's down a bunch. But realistically, how much can we expect forward earnings to be hit with the vast majority of their production in China if it were to be tariffed? Are they going to be able to offset those costs to the consumer? I would imagine not. I mean, you have to think about it. They're already having enough problems selling the Vision Pro. imagine it being 30, 40, 50% more expensive. I mean, that is something that you need to take into consideration when stocks fall like this, especially when they fall a lot. It's mostly due to uncertainty in terms of how much cash flow and how much earnings are going to generate in the future. And we have no idea right now. We have absolutely no idea how long this will linger, how bad it will be, how much global trade will be impacted, whether or not this will drive the global economy into a recession, which again, I believe they're saying, greater than 50% plus chance of these stick around. If that's the case, earnings are likely going to fall. And as a result, your 15, 20% dip in that individual equity might just be adjusting for lower projected earnings in the future. It's very difficult to invest during times like this when uncertainty is so rampant. I mean, I'm going to refresh my page again here. We're up 0.5% on the Nasdaq. So we've gone from down 5 to up 4.5 to down 2 to up 0.5. I mean, this type of volatility, just log off of your account and go outside. Do something. The weather's getting nicer. I mean, stop obsessing over these types of moves. Generally, it does not pay off to be trying to invest a chunk of your money during times like this. We're looking at, if the market were to close under 4% today, we're looking at the worst 3 days on the index since the Great Depression. This would be absolutely brutal, and I see a lot of investors dumping all their money. I mean, if we look back to day one of this, retail investors bought $4.7 billion in stocks on Thursday, the highest level in over the past decade, JP Morgan noted on Friday. The historic buy the dip move by many retail investors. What are we since then? I mean, just this morning, we were 11% lower from that period. I mean, we're looking at a situation where a US president is effectively trying to change the way global trade works. It could materially impact imports, exports, global trade in general. It is going to substantially impact the economies of many countries. Whether or not it does long term, again, just depends on, what he does overall, what type of deals he gets. His underlying motives, I mean, you could think of 10 different reasonings why he's putting these in place. But as long-term investors, all we should really care about is just buying strong companies, buying strong indexes and holding them over the long term, and buying at regular intervals without trying to time in and out of this madness we're going on right now. Because I guarantee you, for the vast majority of retail investors, especially ones who tend to panic, tend to modify their strategies during times like this, it's ultimately not gonna work out well. That's it for the video, everybody. Hope you liked it. Just decided to pop on this Monday morning just because of this volatility and just go over my thoughts overall. As always, everybody, head down below, like the video, subscribe to the channel, grab that free report for 3 free stocks in the description, and I'll see you next time for more great Canadian content.